Swayam Prabha. Digital India. Educated India.
Hello everyone, welcome back to my lecture. So today we are going to talk about taxation in practice. So in our previous lectures we already discussed about optimal taxations and different types of taxations and also tax incidence and economic burden of taxation. So today we'll discuss about some of the examples of taxation, how it happens in practice and also in the real world, and we also will extend our discussion of the Ramsay's taxation. So let us begin with the Ramsay's extension, and then let us take the example of leisure, and then in labor supply curve, if you recollect in our discussion, there is a trade-off between working hour and also the leisure. So in leisure, when we take the example of leisure, so two points that we would like to discuss, like how to impose taxation on leisure, and it is very complicated and very complex. So there could be 2 points here. One is complements with leisure or substitute of taxation with leisure. So Ramsay's basic result, if you recollect, is basically it assumes that goods are independent of leisure, but then it is not true when we bring the discussion of the labor supply. So in reality, some goods are complement to leisure and some goods are substitute to leisure. So in that particular case, how to impose tax and on what we should impose actually taxes. So now let us assume that some of the work actually complements leisure and makes leisure more enjoyable. Like take the example of say cinema, and in cinema let us assume that we buy popcorn or beverage, and then taxation on popcorn and also on beverages will be higher. So that is how leisure can be quantified, and then taxation can be imposed. Similarly, at home, for example, if I take a day off from the work and then I spend more time on spending time with the family, but as a result I also want to watch some series or movies in OTT platform, but then for that I have to buy or I have to subscribe OTT couple of platforms, also mobile data packs. And then if we look at from the taxes point of view, imposition of the taxes on those commodities like say OTT subscriptions or the mobile data packages, we generally see higher taxes or higher GST in case of India is imposed. So now let's take the example of say when we are saying or claiming that some goods are substitute for leisure. Again the complications comes here when we talk about tax and then try to link with say leisure. So work enabling goods, for example cars or bicycles, or say some incentives that will actually motivate me to work more, or say in case of bicycle or car, so car will, with the help of car I can reach office quite before time, and that particular time I can actually spend more in office while working more, so that I can earn more because that will get added to my work performance. And then incentive, for instance, if I'm given more incentive to work more, then of course I'll choose working more over leisure, and then income taxes on my income will be relatively lower on those particular say overtime or the additional income that I get it from working more. So what is the Ramsay's logic here? So if we kind of summarize, then tax complements of leisure more heavily and tax substitutes of leisure less heavily. And what could be the reasons here? So because taxing leisure directly is impossible. That is what the discussion that I began by saying that taxation or tax imposition on leisure is very complex and very complicated, almost next to impossible. But then taxing on different commodities which actually identify that how certain goods, like identifying certain goods which are actually complementing to leisure or substituting to leisure, identify those commodities and then impose the taxes on those certain commodities accordingly. And therefore policymakers, when they frame or design taxes, they should be really careful which are the goods that should be identified, which are connected or linked to the leisure. So now let's move further. The second point that I would like to discuss here while extending Ramsey's discussion is distributional concerns. So Ramsey rules is purely efficiency based, which we already discussed. We also had shown with the deadweight laws, and also we have shown the relationship between taxes, price level, and then deadweight laws. So here when we kind of summarize this particular discussions or expand Ramsey's point, so policymakers care about equity while framing public policy, and this is our initial few lectures. We also give the justifications, and for recollecting that, I would suggest to revisit those initial lectures. So there, especially in a country like like India, where inequality is very high, so equity and equitable distribution and then taxes on those commodities are very, very important while understanding that, and this is also very challenging for the policymakers. So tax goods more if consumed disproportionately by the rich, and tax goods less if consumed largely by the poor. So this is, I think, the discussion that we already put it before. This generates certainly a distributionally weighted inverse elasticity rules. So even we also discussed about and also had shown that how optimal taxation varies with different types of commodities, and then commodities with the different types of elasticities. So that is how we actually tried to explain. And here in this particular case, examples could be like, say, gold, luxury cars, cosmetics, higher income consumption. So these are the taxation on the consumption on certain goods which are say luxury in nature or durable, consumer durable goods. Generally we see that higher taxation, and I can actually take the example of, say, in Indian case, like GST will be higher side on those particular commodities. So now basic necessities, like needless to say this, like rice, wheat, fresh vegetables, and others, like for example some of the medicines like consumed by the poor and life saving, so their tax should be very low. So that is how taxes and different slabs of the taxes, even in context of, say, GST, so that's how the different slabs should be defined by the policymakers. So now let's move to real world use of Ramsey taxation in case of, say, India. So sin taxes that we know is like negative externalities and low elasticity. And then in negative externalities we already discussed quite a lot. So like, say, goods with low elasticity and negative health effects like cigarette, different like tobacco, gutka, pan masala in case of India. Then alcohols, when we consider alcohol, then state excise duties. So elastic demand, of course, like no, people continue consume certain this particular goods, even there are health hazard declarations, but still people, these particular commodities will also be produced and also be consumed. So therefore large revenue and moderation distortion. So let's put higher taxes on those certain goods, and therefore tax revenue will be higher, and that will be the more resources for the state for redistributional point of view. So now the second case that we also have discussed is like fuel taxes. So in fuel taxes, for example, petrol and diesel have very inelastic demand in India. Why? Because weak public transportations, like say, even one can also consider the example of say organized cities or planned cities like say Chandigarh or other places like Gandhinagar. You will see that dependency on the public transportation is much lesser as compared to the private, and therefore like say petrol and diesel consumption is high, and this is like true in case of many cities, and then no close substitute for commuting, and therefore people they need to buy private vehicles, and essential input for supply chain, for instance. So there we have to have higher taxes, and India imposes high excise duties on petrol and diesel. So this is one of the reasons why taxes on petrol and diesels are high, because it's inelastic goods. And this is also Ramsey's explanations, like for instance Ramsey's tax, like high tax low elasticity goods to raise revenue efficiently, so that those tax revenue can be utilized as a government spending, and then revenue and like for instance tax revenue and government expenditures, how they are related, we already discussed in our previous lectures. Sugar and junk food, for instance, so these are like couple of cases or examples. Like state have debated like fat taxes, like for instance Kerala in 2016 introduced 14.5% taxes on the junk food, and also there is a debate like junk food stalls or the shops should not be established nearby schools, so that we can actually prevent children to buy those particular commodities and consume. And demand is not very highly elastic, and therefore this certainly align with the Ramsey's principles. So these are the couple of examples and then explanations how optimal taxations and how one can extend Ramsey's explanations further to understand better in different contexts. And then examples that we had given, these are examples that we have taken from India. So now taxations and savings, this is important because when we say save money, we invest or we save money in bank, and then we get return, and then that return actually depends or change my behavior on certain consumption of certain goods. So definitely consumers behavior will be changing, and therefore taxation and saving, this particular discussion needs to be kind of discussed. Although we discussed some parts and bits in our previous lecture, so let us discuss here a bit and spend a little more time on taxation and try to connect with the savings. So the role of saving is very important, is to smooth consumptions over time period. Like sometimes we save more, sometimes we work more, for instance, and then we earn more, and then we save. Why? Because of future, just try to address uncertainty in future, because post retirement generally pension or the savings whatever we do is much lesser as compared to income or earnings during the active working lives or active working period. So therefore savings are important, and then savings needs to be there for future consumptions, and also to address certain uncertainties. So individuals have income, more income in some period. Like if we look at temporal's point of view, in some time, as we discussed, like sometimes we earn more, like income is more, such as during our working lives, and less during some period, sometimes, like especially post retirement, and that's how we have to understand the consumption. pattern and also saving patterns. So when we look at intertemporal choice of savings, what does that mean? Very traditional and basic theories on savings are also discussed, and also these are the points were also discussed in context of those traditional saving theories. So what does that mean? The choice about how much save is a choice about how to allocate one's consumption over time. So it is, when we are talking about savings, it is not that we are talking about savings, we are actually talking about how should we consume, because we already know that whether it is in case of individual or even for the macro point of view. So y is equals to c plus s, and certainly s will be equals to y minus c. So when we try to understand or try to get more of savings, then we have to actually understand different behavior of the consumption, because if you want to increase your savings, then certainly consumption has to be reduced and consumption has to be mindfully be consumed. For instance, if I look at from this point of view, so if I want to increase savings, then certainly consumption has to be decreased if income is constant. If income is increasing, then proportionately savings will be there, because we already know that savings and income both are positively related. So here when we are trying to talk about saving, so actually savings behavior actually depends on consumers' consumption behavior. So this is what we are trying to understand, that intertemporal choice of savings. When we are talking about it, we are actually talking about choice of consumptions. So how it is actually related? So budget point that will come here, like when we save more. So this is very typical economic logic, like when saving will be more, then obviously from the equilibrium point that we needs to save in the bank, and that needs to be invested somewhere, or I may also invest somewhere. So I will have return will be high, and when return is high, then certainly for the next period, like if I start this saving, like say from T1 period, and then after getting return, like after 1 year, like say in T2 period, then obviously income will be higher. Why? Or say savings will be higher. Why? Because rate of return will be added or rate of interest will be higher, and therefore savings in period 2 will be higher than savings in period 1. So this is very typical, and therefore when we think from the consumption's point of view, my budget, like say budget constant, like say in period 1, will be different than budget constant in period 2. So this is very typical and very economic, logical, traditional theories also talks about this. So when savings will be high, and therefore if you remember, we already discussed that when we try to save, let's not give any loan from economics point of view, and if we think like an economist, so it's basically when we save, we are not supposed to save and keep it, or we keep it at home. So it has to be there in a financial institutions where it will regenerate, like we'll get the return on savings, and then it has to be higher income for me or higher savings for me for the next period. So this is how taxes, and then one should be really careful that how taxes should be imposed and where taxes should be imposed. So when we look at taxes here, so that then it will be very careful calculations here, like say if I consider savings. So savings for the 2 period, like when I start with say S1, it's like savings coming from period 1, and then I'm investing or I'm saving on the in the bank, and then I get rate of return on that initial savings, and therefore I'll get the total savings is like S multiplied by 1 plus R. R is the rate of return per unit for per unit savings, and then even it will be true in case of say income. So this is how it will get calculated between two period, between two savings, right. So here one more point that I would like to highlight, like here where to put the taxes. So taxes actually will be imposed on the overall savings that I get it, like return that I get it in the period 2, and there actually tax will be imposed or levied, and this is how taxes and savings and taxes and investment, they are interrelated. So now let's move to the next, is like different forms of taxes on risk taking and the wealth. So we already know how it works, but then different types of taxes that we don't know. Let's have a just kind of discuss this. Say, what is capital gain? So the difference between an asset's purchase price and its sale. So when we buy any asset, like say home or anything, when we purchase that, so that is the price. The difference that we get it from the asset is basically the purchase price and its sales price. So how that particular difference, if it is positive, then it will be capital gain. Capital gain, if it is not a good buy of the property or the asset, then it will be capital loss. So now taxation on actuarial means taxes when taxes are paid each period on the return earned by an asset in that particular period. Like when I kind of invest or buy asset, or say invest, and then I'm getting interest, and then on that particular interest, that but for particular period, like for every year, if tax is levied or tax is imposed, then that is called taxation on actuarial. And then taxation on realization is basically the taxes when it is paid on assets return only when the asset is sold. So when I buy any asset, and then if I sell that asset after say 5 years, and then I'm paying taxes after the 5 years on the total valuation of the asset, that will be considered as taxation on the realizations. So lock-in effect, also lock-in period is often discussed when we talk about taxes, investment on certain say SIPs or mutual funds or somewhere. So there is a lock-in period or lock-in effect, what we call lock-in effect, to minimize the present discounted value, and we already know how to calculate the present discounted value of capital gains tax payment. Individuals delay selling, and therefore individuals behavior is like delaying selling their capital assets, locking their assets, like say for 2 years, 3 years. So when we invest somewhere, some of the say some life insurance, we can't actually get that. I mean, once we invest, we can't easily get it return immediately after 1 year or 2 years. In some of the investment it is 3 years, some of the investment 7 years, some of the investment 25 years are actually locking period. So and also valuation also varies accordingly, and therefore when individuals invest, they generally wait for the better value, and therefore they delay in selling those capital assets. So now transfer tax, a tax levied on the transfer of assets from one individual to another, and that's how tax gets calculated. And gift tax, a tax levied on the asset that individuals gives to another in the form of a gift. So imposition of the taxes on those particular assets or goods will be referred as gift tax. Estate tax, tax levied on the assets of the deceased that are when a person passed away, and then that particular property and then taxes on that, imposition of taxes on that, that is called estate tax. The property tax, a tax levied on the value of real estate, including the value of the land or any of the structures that are imposed, like built on that particular land, like anything like house or factory, whatever is built on that particular land. So that becomes the overall property, and then when tax is getting calculated is basically over on the overall property of that particular real estate. So then value needs to be calculated, and that's how taxes should be imposed. So now let's come to an important discussion is like corporate tax, like taxes on the business or taxes on the income from the business, like how that actually happens. So generally taxes, this is the equation that if we can say like equation 1. So here when we are talking about business or corporations, is basically the revenue minus expenditure. So that is the net return, and then on that particular difference, like balance, like after expenses, whatever the amount that corporation gets, tax will be imposed on that. So per unit taxes, like tax rate will be imposed, and then if we also deduct tax credits from that but overall amount, that is the total amount of taxes that corporation needs to pay. So now let us understand what are these things, each component, for clarity. So what is revenue? As we already know, so these revenues are for the firm. It is earned by selling goods and services to the market. So simply total revenue will be like, say, P is a price determined for this per unit of goods or services, and then total quantity, if we refer as like say Q is the total quantity of or total units of goods and services that a company or firm is actually selling. So this will be referred as total revenue. So total revenue, as we know as a student of economics, is like P and Q. So this is called total revenue. So what are the expenses? As we know, expenses are actually the cost for production. So there are 3 different types. I'm just reiterating once again. Cash flow, like cost of holding business, like cost of production for the firms or for the business. So interest payment, like when anyone or group of people, they will begin their business or any sort of ventures, like including startups. So if they don't have money, they have to borrow from financial institutions, and then as a result, rate of interest or cost of borrowing needs to be paid to the financial institutions. So that is the rate of rate of interest payment. So when cost for the company or business needs to be counted, like total expenses, so it is not only the cost for say cost for raw materials or any other basic necessary things, but then also for the under the expenses, interest payment needs to be calculated. The third component is the depreciation on the capital investment. Like when we buy or require any sort of capital equipment in the say in the corporate world, it's number of desktop or number of high softwares, or in the factory, like different types of capital equipments, and then that will have the depreciation cost, and then that depreciation cost, whether it is annual or maintenance cost quarterly, so those costs also needs to be calculated when we understand the total expenses. So total expenses, therefore for any corporation or for any business, there are 3 components. One is simple cash flow, like simple cost for any raw materials or for the recurring cost, like say cost for maintaining total number of laborers for their wages and etc. And then interest payment, if we borrow or if company or corporation borrows money from the bank, then interest payments, and then for the capital investment there is a depreciation that also needs to be counted in the expenses. Therefore, when we try to calculate revenue and expenses, so at the time of profit calculation, that needs to be really very careful calculations, like how we actually try to get it how much profit. So when we try to say that profit maximization is a rational behavior for the producers, is basically revenue minus expenses, overall expenses, and then that will be the profit. If it is positive, of course, if revenue is more than expenses, then it is positive, and that is how the profit, and that is what rational producers always try to maximize. So now what is tax credit? So tax credit is basically also referred as investment tax credit, which allows firms to deduct a percentage of their annual qualified investment expenditure from the amount they owed in taxes. So this is also one of the components for the corporation to keep it, and then it also needs to be deducted from the balance between revenue and expenses, and that is the amount of taxes that needs to be paid to the government. So here I stop. So these are the two references that I have used for this particular lecture, especially while discussing taxation in practice. So Jonathan Gruber and Joseph Stiglitz, these two books will be helpful, and a lot of explanations are there if you want to go much more in details in terms of explanations and more examples to follow. So I would certainly request you to follow these two reference books as other lectures as well. So thank you very much for your attention, and I hope you enjoyed this lecture.